What is inheritance tax and how does it affect generational wealth transfer? Imagine passing down a family business or a home to your children and grandchildren. Now, think about what happens when taxes take a slice of that inheritance. That's what inheritance tax is all about. It is a tax that some states in the United States impose on assets inherited from a deceased person. The tax is usually based on the value of the property or money received. In the United States, there is no federal inheritance tax, but a federal estate tax does exist. The estate tax applies to very large estates before they are divided among heirs. The estate tax is calculated on the total value of the deceased person's estate, which can include homes, investments, and business interests. Beneficiaries then pay inheritance tax on what they receive, depending on the state laws. Inheritance tax can reduce the amount of wealth that families pass down through generations. When taxes are high, heirs might have to sell parts of the inherited assets to pay the tax bill. This can make it harder for families to keep their wealth intact over time. For minority business owners, this can be especially tough. They often start with less money and fewer assets, so a big inheritance tax can force them to sell part of their business or other assets just to cover the tax. To keep wealth within the family, many minority entrepreneurs plan carefully. They might set up legal structures like family limited partnerships or limited liability companies. These help transfer ownership gradually and can lower the taxable value of the assets. Some also use life insurance policies to pay taxes without selling important assets. Trusts are another tool, especially certain types called irrevocable life insurance trusts, which move assets outside the taxable estate. Planning ahead is key. By preparing a clear succession plan, business owners can train heirs and managers to take over smoothly. This helps keep the business running and preserves wealth for future generations. Some families also use charitable giving strategies to reduce estate taxes and support causes they care about. Because minority families often have less access to capital, taxes from inheritance can hit harder. If they don't plan well, they risk losing assets to taxes or having to sell their business. This can widen the wealth gap and slow down economic progress in their communities. Understanding inheritance tax and taking steps to reduce its impact is vital for minority business owners. Proper planning can help transfer wealth and business ownership successfully, creating a stronger foundation for future generations and helping build long-term success.